Okay. Now we have another set of data wherein what we have is we have Nifty monthly data. So what we have done is we have got the monthly return data of Nifty. Okay, this I have taken from the Yahoo website. I will show you how you can, I have got from the NSE website. I will show you how you will get it from the NSE website. Okay, now we need to do certain computation. What we have is, let's see, I will put over here. Okay, so they are saying to compute. So this is a Nifty monthly data sheet. The computation that I have to do is, they are saying that if you had bought Nifty 50 shares of Nifty on 1st May 2012. Now you have to search where is 1st May 2012. I think this should be 2nd May, because 1st May was a holiday, so you did not have 1st May data, so you have 2nd May. So 2nd May is 4924. So what we'll do is, let's say this, we'll copy 4924. So 2nd May I bought 50 stocks of Nifty. Each of this stock was 4942 priced. So let's say my price is this, number I bought is 50. Okay, and so what is my total investment? So my total investment is will be this price into the number of shares. So this is my total investment, 2,46,213. Okay, and they are saying that you sold your entire holding on 1st Jan. So let's say we can put over here date 2nd May. So we can put over here 2nd May, and then I can put over here 1st Jan. Okay, so they are saying that you have sold the entire thing on 1st of Jan. So where 1st of Jan, it is 6016. So what we'll do is, we'll go over here and 6016. I'm selling my entire thing, so I will copy this over here. Now I can also put the formula over here and compute the selling value, but what I will do is, I will just use this drag and drop. Either I can drag this and get the final value, or I can copy this and paste it over here. Okay, so this is the final value. So I bought at this, I sold at this. This is my entire investment realized. So what is my return? So holding period return, they are asking. Holding period return will be your, we know that it will be equal to final value minus initial value divided by initial value. So this is your 22% return that you have got. Okay, this could also be computed from here, but please note that this return you have computed over how many months? So you have May. So from May to January you have computed the return, you have got this. So from May to January, if you compute, there are total of 8 months. In 8 months you have generated this 22%. So if somebody asks you that you have an investment which gives you in a year 25% return, and you have this return, this investment which gives you 22% return in 8 months, which would you prefer? Okay, definitely you would prefer this one, because 22% in 8 months is much better than 25% in 1 year. But if that person says that he will give you 32% return in 1 year, and here you will generate 22% return, which is better? Okay, so what happens is, like, you have to get this from 8-month period to an annual period, right? So that you will be able to compare apple with apple, right? So you would want to convert this return from here to an annual return. That would be a much better thing to do. So would want to do that. So if you see this 22.17 return is for 8 months, we would want the return to be computed over this 8 months, how much it would become when we have the 12 month, right? So that computation is known as effective annual rate. So we need to find out the formula for the effective annual rate, how these things are done. Let us see how we can get the effective annual rate computation. Okay, so effective annual rate. Okay, so think about you are investing $100 and the bank has said that they will give you 10% per annum, but the compounding would be done on a semi-annual period. That is, this 10% is first compounded at 5% for 6 months and then again 5% for the next 6 months. So this 5%, again 5%. So on 1st Jan, if you started investing, on 31st December you will get 5 and 5, and this will be on your 30th of June. Okay, so I want to know how much would be your investment value at the end of 30th June and over here. Okay, so if you see 100 is getting compounded at 5%, so the value here will be $100 into 1 plus R, okay, to the power 1, because you know this is your compounding concept. So it is 100 into 1.05, which is 105. So this is the value that you have over here. Okay, and then 105 again. Please note that now over here the actual investment is 105, not 100. Okay, so this 5% would be computed on this 105. So what you have is 105 into 1.05, that would become 110.25. So the return that you have got is 110.25 minus 100 divided by 100. So the holding period return. So this is your 10.25%. So the holding period return is 10.25%. Okay, so this is holding period is 1 year. So for 1 year holding period, we call that as effective annual rate. Okay, now how to compute this effective annual rate? Effective annual rate formula is pretty simple over here. Okay, only thing is we need to understand in terms of holding period return. Here our holding period, this is if our holding period is, it is 6 months. Okay, so in 6 months we were generating 5% return. Okay, so what we can do is over here we can say that over a 6 month period I was generating 5%, and total we have 2 holding period. So my effective annual rate would be given as 1 plus 5% to the power 2 minus 1. If you compute, it will become exactly this value. So the formula for effective annual rate is given as 1 plus holding period return, and this 2 is the number of periods or number of holding periods in 1 year. How many holding periods you had in 1 year minus 1. So this will give you your effective annual rate. Okay, in the problem that we had holding period was 8 months, and in this 8 months we are getting approximately 22% return. We want to compute this effective annual rate, so we want to find out how many 8 months are there in 1 year. So what we can do is we can have a very simple concept that in 1 year we have 12 months. So what we say is in 12 months is 1 year. Okay, so how much, we have 8 months is 1 period. Okay, so 1 month will be 1 by 8 period. How much will be 12 month? 12 month will be 12 by 8 period. This is your unitary method concept. Okay, so what we can say is this number of periods in 1 year, number of periods in 1 year can be written as number of months in 1 year, which we know is 12, divided by months in holding period, right? So this can be written as 12 divided by months in holding period. Now if they want to ask this number of periods but the holding period are in days, then you would use 365 by the number of days in holding period. That would be your formula for the number of periods in 1 year, right? So we'll see that how we can do the same thing in Excel. So we can use 1 plus holding period is this. Now what we have is, when we have to do the to the power, for to the power we will use the caret sign which is above 6. So we'll have to press 6 and then we have to press shift button and then press 6. So this caret button will come or symbol will come, and then we have to do 12 divided by 8. So this is becoming, and then we have to do -1. So this has become your effective annual rate. So then we have to do the format painter. So 35.04 is what you are actually returning in a year if you generate this much in 8 months. Okay, so this is our understanding, right? So if you see the formula again, it is 1 plus G11. G11 is the holding period to the power 12. 12 is the number of so what we have is, we'll put this, I will show using this. So what you have is this G11 is a reference to here, okay, G and then 11, okay. Then you have to the power 12. 12 we know that is the number of months in a year, and this 8 has come because we bought on 2nd May and sold on 1st Jan, right? So that is why 8 has come, because that gap over here between these two is 8 months. Please note that it is 8 months and not 9 months. Okay, and then ultimately that -1 is coming because we have to do the -1 at the end. The formula is 1 plus HPR to the power number of periods -1. This is how you will get this computation. Okay, I hope this is clear to you. Okay, thanks a lot for watching this concept. However, what we have is, we have other concepts also which we have covered in the next problems. Okay, the next problem is says that what is the monthly compounded rate of return that you have generated. Okay, so over the 8-month period, over 8-month period you have generated this much return. Okay, but I want to know that how much is the monthly return, monthly how much you have produced. That is one thing which is important for me to understand, right? Because many times people would want to compare monthly data or want to know the monthly return. Okay, now this is a very simple stuff if you understand the concept, right? We have computed earlier geometric mean concept. So if you understand this geometric mean was trying to get the average. Okay, we have a similar concept like geometric mean, which is called as CAGR, compounded annual average growth rate. Compounded average growth rate and GM are one and the same thing. Okay, so what happens if you see this, we have generated 22% return, or approximately over a period of 8 months. I want to say that how much X% return that you will generate every month, X% that you will generate every month, such that this cumulative X% would be equal to this 22%. Okay, so what we can say is, let's say if I am generating X% return every month, so because we have to do the compounding, so assume that you invested $1. You are investing $1 over here. Each money is getting compounded at a rate of X% over how many months? 8 months. So this is the final amount that you have. So this is the final amount. Okay, this amount is equal to the amount that you will generate over here, which is $1 into 1 plus whatever you have generated, let's say 22% or 22.17% return. Right? So here we need to compute this X. Now how do you compute this X? So if you see, eliminating that $1, so it will become 1 plus, let's say we put it over here R. Okay, and here we had to the power 8. So what we will do is, this 8 will go over here. Okay, so it is 1 plus X% will be equal to 1 plus R to the power 8, correct? And then X% will be equal to 1 plus R to the power 1 by 8 minus 1. So this is the return that would get generated on a monthly basis. So compounded average growth rate, here it is monthly. Most people use compounded CAGR quarterly, yearly. Okay, here we have used the CAGR concept monthly. Let us try to implement the same thing in Excel over here. So what we have is, I want to compute this CAGR. CAGR computation, as we know, it will be 1 plus the return that you have to the power, okay, 1 by 8. Now as of now, it is, I am putting this 1 by 8, but it will be better if you put over here how much number of months. So let's say number of months you can put over here. Okay, you can put number of months, okay, which is 8. Okay, it's a better practice to reference these things. Okay, so you can use this number of months as 8. So CAGR will be equal to 1 plus the return this you have produced to the power 1 divided by the number of months you have, and then minus 1. This is the monthly return that you have generated, but again it is not in the percentage form, so this is in the percentage form. 2.454% is your CAGR monthly. Okay, next problem is your friend, he bought Nifty on 1st December 2008. Okay, I think it should be 1st Jan 2008. Okay, yeah, it's 1st December 2008, don't worry. Yeah, so he bought on 1st December 2008, that means the value was 2959. Okay, and he sold on 1st Jan 2013, so that means 1st Jan 2013. So he has sold over here. Okay, so 1st Jan 2013 is sold. He bought on 1st December 2008. We want to find out whether he has given more return or you have given more return. Now if you try to compute the return over here, this minus this divided by this, right, and if you get it in percentage format, oops, he has given 103% return and you have given only 22% return. Okay, now I want to know who has given better performance. Okay, whether you have given better performance. Okay, so we want to know who has given better performance, whether this is better performance or this is better performance. Okay, please note that this performance is generated in a period of 8 months. Okay, however, this performance has been generated over a period. You have to compute. Okay, you need to compute how many months are there. So you have 2008 December, let's say 2009 entirely, 10 entirely, 11 entirely, 12. So 12 into 4, 48 months plus 1 month. So you have total of 49 months. Okay, now I want to know that 103% over 49 months is better or 22% over 8 months is better. That is what we need to compute. Now how do you get it? The best way to get it is to bring both of these returns at a similar level. Either you can bring it on a CAGR basis, okay, monthly basis, you can get it on a effective annual yield basis. Please note that this is a CAGR over an annual case. This is a CAGR over a monthly case. Whichever you would want, you can get it. So let's say we want to do both. Okay, so let's put over here the number of months in this case. So the number of months in this case would be equal to 49. Please remember 49. How? Because 1st Jan, here it is 1st Jan 13. Here you have 1st Jan 13. So 4 full years plus 1 month. Now how do you get the effective annual rate? Effective annual rate for this can be computed. So we'll say effective annual rate will be equal to 1 plus your holding period to the power how many holding periods are there in this. So if you see, we said that 12 divided by the number of months in the holding period, which is 49. Instead of 49, I will select this better approach and then minus 1. So I can put the format painter and I can say that effective annual return is 18.98. So your friend has also given good return, but he has not given better return than you. You have generated 35% return. You have given this return. Your friend has given on an annual basis this return. Okay. Another way to compute it on a CAGR basis. Let's see on a CAGR basis, how do you compute? It will be CAGR is equal to whatever the return that you have got, 1 plus the return that you have got to the power 1 over the number of months you have. We know that the number of months is 49 minus 1. So on a CAGR basis, if I want to convert, it is 1.46%. So he has given 1.46% return monthly, you have given 2.54% return monthly, much more than your friend. So you have given a better performance. This is how this is computed. Okay. Thanks for watching this video. I hope you would have understood this concept that we have.